Hey everyone, wanted to take a few minutes to record a quick video because I just got done talking to somebody who is new to investing, and the conversation kind of coincided with a presentation we are giving to the Chardon Chamber of Commerce in January of 2024. Gentleman is brand new to investing. He's only been investing for about a year and a half. And his question to me was, I expected with a historic market return to have 8 to 10% growth in my accounts over the past year and a half. Depending on what you were invested in, the market cap weighted S&P 500, which is the one that most people refer to when they say the market is up or down, is positive for the year. But if we look at what's called the equal weight ETF, the equal weight S&P 500 ETF, which puts equal investment weight in all 503 stocks that are in that index, that one's actually down for the year. And both of them are down from their high point back in 2021. And so his question was, am I doing something wrong? Should I be investing in something different? And I think one of the best things you can do if you are a do-it-yourselfer is create an investor engagement letter. Let me explain that. When we work with a client, we sit down and we listen to their goals, their objectives, their values, what they expect out of the account, what we want this account to do. And the answers to those questions tell us how that account should be invested. We're going to know the length of time that we're going to be invested this money. That'll tell us what type of account it will be in. It'll tell us what type of investments are appropriate for that time horizon. I want to go into what typically is in a client engagement letter. After we have met with the client, after we have determined what their goals are, we use that letter to measure ourselves from year to year. And let me explain. The first thing that you should do, anytime that you save or invest money, the first thing you should do is ask yourself, what am I saving or investing that money for? And you should get into that, not only, the object, what I'm investing it for. It could be education. It could be retirement. It could be a summer home. It could be the opportunity to buy a rental property into the future. All that will tell us what type of account we're going to use to grow that investment. If I'm saving for long-term retirement, well then I'm going to probably use an account that is tax preferred for that. It might be a Roth IRA so that I can withdraw that money tax-free in retirement. If I'm in a high tax bracket right now, I might be using a tax deductible or tax deferred investment in order to do that, such as a traditional IRA or a SEP IRA. But in addition to that, I think we want to get into what are my values, right? If the answer to my question is I want to be able to spend more time with my family now, that tells me I want to generate additional income so that I'm not necessarily relying on my day job in order to provide for my living costs. So passive income might be very important to me. Understanding the value of why I'm saving money is important because that also tells me the investments that I'm in. If my objective is passive income, well, then I'm not chasing the shiny startup tech stock that I'm going to hang on to for 20 years because it's not going to pay a dividend. It's not going to provide that passive income I'm looking for. So first part of an engagement letter that you're going to write to yourself is, what are my goals? And you literally spell that out. This is my objective. The second thing we want to do is, once we determine what that goal is, we have to figure out how to reverse engineer it. If my goal is to be able to retire at age 60 and to be able to withdraw $100,000 a year from my investment accounts, I need to figure out how much I need to accumulate in order to get to that amount. This might be something that it would be helpful to sit down with somebody who is skilled at financial planning. But if you're a do-it-yourselfer, this is something that could be done on a calculator. MoneyChimp.com is a website that offers a financial calculator that allows for compounding. So you can have your starting value. You can put in there how much you're going to add to each year. You can put in there the expected growth rate, and then of course the rate of return that you're going to earn over that period of time, which is the growth rate I just mentioned. And then it'll calculate that. It'll give you a figure. And then as a general rule, whatever figure you come up with, if you're retiring after the age of 60, if you take anywhere from 4 and on the high end 5% of whatever that is, that would be an amount that I could probably expect to withdraw from the account and have a pretty confident feeling that I'm not going to outlive that money. Starting with 4%. I would start on the low end of that, just to be safe. Anytime you do projections, you want to err on the side of caution. That amount is not, hopefully, all that could be there in retirement. If you've paid into Social Security or if you've paid into some sort of pension, we could consider that income as well. So if I'm retiring at age 60, I know for those first 2 years, I have to fund that retirement all by myself, right? So I might need to save a little bit more than I think. Why is that? Well, because Social Security doesn't kick in until age 62 at the earliest. You can delay it. For most people my age, I'm 46. Full retirement age would be 67. So every year I delay taking that Social Security, that Social Security benefit grows by 8% simple interest. The purpose is we want to deconstruct how to achieve that goal. So that's what the engagement letter does. I've stated the goal. Now I have to tell myself how I'm going to do that. Once I calculate where I need to be with total assets, whether that asset is to provide for retirement income or if that is to purchase a rental property, doesn't matter. I need an accumulation goal. I'm starting from here. I need to get from here. That'll tell me how much I can fund or how much I have to fund, and also the rate of return that I'm going to need to get. The higher my funding, the lower the rate of return that I need to get. As a general rule, everybody's different. If you're starting late in retirement, this is different. But if you're starting in your 20s and 30s, I would say 15% savings rate or better is where we ultimately need to be. Where that goes largely depends on your goal. If it's retirement, I can have the tax preferential accounts like the Roth IRA or a tax deductible. If it's something that I am going to need in the next couple of years prior to retirement age, I don't want to put that in an IRA. I don't want to put that in a retirement account that has restrictions for access. I want to put that in an individual, or it's sometimes called a non-qualified account, because I can pull that out without any penalty and I have access to all that money there. The engagement letter lists our goals, how we are going to get there, and then lastly, what we're going to do is determine how we measure our success, because I can promise you any plan that you start is going to need adjusted. There's no such thing as a plan that is set in place and works like clockwork perfectly for 20 years. The reason we set a plan, the reason we create a financial plan, is because it gives us a basis to make rational adjustments, well thought out adjustments to make sure that we stay on course. For instance, let's say that I determine that in order to reach my accumulation goal, I need to have my starting value, and then I'm going to continue to put 15% of my income into my savings and investments. And let's say to reach that savings goal, I have reversed that, engineered that, and I discover that I need to have at least a 7% return. 7% compounding return over that period of time. The thing to remember is you are highly unlikely to achieve that number every year. Markets simply don't work like that. If you look at the S&P 500, somebody might cite it over a 20-year period of time, and they might say, look at this. This investment has averaged 9.5% over that period of time. There are very few years where it actually does 9.5%. It's 15% up, it's 10% down. The average of that is that 9.5. So I would highly recommend that if I'm saving for a long-term investment, you're measuring the success of your investments not over quarter to quarter or even year to year. I personally take blocks of 5 years. And that's how I determine if I'm on course or not. If I'm falling behind, I might need more horsepower. If you look at a theory that's called modern portfolio theory, that basically looks at the return that we achieve in our account long-term is largely based on beta, is largely based on our ability to tolerate the fluctuations within the account. The more fluctuation I'm able to stomach within my account, the longer long-term growth rate I would expect to have in that account. Keep in mind that it's very important that as your time horizon shortens, because high volatility investments may take years for them to recover, we want to make sure that we actually begin to make that account a little bit more conservative as we approach that X date. Why am I saying this? Because as getting back to my new investor that I spoke with today, he was a little bit frustrated, right? That he had just started investing, and his first year and a half in the investment world was lackluster. At least historically speaking, it's been lackluster. The other thing that helps is to be a student of history. If we look at the market returns from 2000 to 2003, those were 3 pretty significantly down years right in a row, right? Still, that hasn't disrupted the market's ability to return 8 to 10% over multi-decades, right? We expect to go through periods of downturn. That's just how the cycles work. And if you're going to be investing, especially in stocks, you must be willing to fund your account when the account is not providing 10% growth. That is how you're going to achieve that 10% growth, because you have to be able to fund the account when others stop funding their accounts. When others are fleeing and selling their investments, you have to be able to go in and continue to dollar cost average and buy those investments. So if you're a do-it-yourselfer, it will improve your success, is to write yourself your own engagement letter. This keeps you on track. Every time you feel like making changes, I want you to review that engagement letter to remember what my initial objective was in starting my retirement account, starting my investment account. It's going to have the goals, define the process, how we're going to get there, and then it will ultimately decide how we are going to monitor this account and how we are going to make adjustments to that. If you have any questions, give us a call. You can find us at crosbyadvisory.com, and I'll see you next time. Keep in mind that investing involves risk, including the potential loss of principal, and you should carefully consider all risks and fees before making an investment. Crosby Advisory is a registered investment advisor in the state of Ohio, Florida, and Texas. Thank you very much.